Hi, everyone. So welcome to the stream today. Very much excited for having you on the stream. Today, we continue with our Executive Leadership Masterclass with focus on financial reporting and corporate reporting. And we want to look at consolidated financial statements. If you're writing your ACCA, your ICAG, your CIMA, CFA examination, this topic or this area of the syllabus is very, very critical, because whether you like it or not, there is a question in the exam hall. Hi, that the examiner is going to be. Today, very much excited for having you on the stream. Today we continue with our executive in relation to that. So if you join the stream, let me know in the chat box, whatever questions you have, put them in the chat box for me. Let's see. Okay, in October, good evening. Welcome to the stream. I believe you are doing well. So put it in the comment box. Let's see the roll call. Who do we have here? Okay, so give us a thumbs up on the video. That way we get more engagement on the video, and then YouTube will be able to push it so other people can watch. So together we can grow the channel in relation to that. You know, this is all because of you, and this is what I want to do to assist you so you can prepare well for your examination. So welcome to the stream today. We're looking at consolidated financial statement. But in addition to that, I'm going to be certainly answering all of your questions. So go to the chat box, comment below with your questions. What do you want me to talk about? Okay, Andrew Oponbeko, I see you. Kledos, I see you. You guys are welcome. So let me know in the chat box, how are you guys doing? Let's see the roll call, which people are on the stream now. Give us a thumbs up on the main video. That way we get a more engagement on the video, and YouTube will be able to push it so we can reach as much students as possible. Today we want to look at consolidated financial statements. Joseph Udam, you are welcome. I see your thumbs up on the chat box. Give us a thumbs up as well on the main video page in relation to that. Now, tell me in the chat box, what is your view about consolidated financial statement? Is it a topic you like? It's a topic you don't like? What is your challenge when it comes to the consolidated financial statement? Put it in the chat box and tell me about your view in relation to the consolidated financial statement. Is this something you enjoy? Is this something you see as a difficult area, or something you see as an easy area? Let me know in the chat box. What's your view on the consolidated financial statement? I've met a lot of students who have mixed view about the consolidated financial statement. Now, almost every student writing financial reporting or corporate reporting is excited about consolidated financial statement. I remember before the coronavirus and the school closures and stuff, Chirujot Vincent, I see you. Thank you for the thumbs up. So before the closure of schools and when we were having lectures, my financial reporting students would be like, Nhyira, when are we doing consolidation? When are we doing consolidation? When are we doing consolidation? So it's like every student wants to look at consolidation. I don't know, students see it as is the master brainer or the mastermind topic in corporate reporting or financial reporting. But I tell students all the time that yes, consolidation is an easy area, but it has its own principles that guides it. And your ability to be able to excel in consolidation is to understand the fundamental and the basic principles. It is not just about solving a lot of questions. One thing I share with you guys all the time, Emmanuel Addison, I see you. You are welcome. Richard Amegashi, I see you. You are welcome. Thank you for joining the stream today. Give us a thumbs up on the main video page. That way we get more engagement on the video, and YouTube will be able to push it so others can also join the stream and watch the video. And then you can also share on your WhatsApp platforms, your Telegram, your Facebook groups, so that we get a lot of people joining the stream and benefiting from this very fundamental and critical topic in financial reporting, corporate reporting, advanced financial reporting in relation to that. So I tell students all the time that consolidation is an easy area. It doesn't matter how many questions you solve. It is about understanding the principles. So there are basic principles that you need to understand when it comes to the preparation of the consolidated financial statements. And it doesn't matter how many questions you solve, if you don't understand these principles, if you don't understand these concepts, if you don't understand these basic treatments and minor issues, then you're going to be struggling in the consolidated financial statement. And so that is what I want to do today, to explain to you the basic principles and concepts that you have to understand when it comes to the preparation of the consolidated financial statement in relation to that, so that you will know what to do, how to go about it, the basic issues that you need to understand in relation to how you can present the financial statement in that case. So, so if you join the stream, comment in the chat box whatever questions you have. I'm going to be reading all of your comments and we'll be answering them. Tamba, Brima, I see you. You are welcome. Give us a thumbs up on the main video page as well. Not only in the chat box, on the main video page. Give us a thumbs up as well on that. So when it comes to consolidated financial statements, there are a couple of accounting standards that are in place here that we need to look at. The issue in relation to IFRS 10, it's one of the basic accounting standards that we need to look out for here, because it's an accounting standard that is basic, gives us a lot of the principles and the concepts that we need to understand when it comes to consolidated financial statements. Now, off the bat, we need to find out a couple of fundamental principles when it comes to consolidated financial statements. So why consolidated financial statement? Someone may ask, why consolidated financial statement? Consolidated financial statement because companies want to expand and grow. And in their goals, their objectives of expanding and growing, they end up acquiring other companies. So there is what is called the organic growth, which is where you are starting the business from scratch, using your resources, using your labor force and all of that. So you start everything on scratch, and then you have the business there. Then another way to grow, which all other things being equal, it's more rapid, is through acquisition of other businesses. So the acquisition of the business could be a straight up acquisition, or it could be a step acquisition in relation to that. So the acquisition can give you either what is called a significant influence, and we'll get into all of these in a moment. Significant influence. And then you can also get control on the acquisition. So either you are acquiring a company and you're getting significant influence, like I said, we'll get into that in a moment, or you are getting control in relation to that. So this enables businesses to expand and grow. But our focus on consolidated financial statement is where we acquire the business and we gain control. And I'll come to how we gain control in a moment. But when we can gain control, it means that we are going to have one company refers to as the parent company, that is the company that controls one or more entities. And then the company that we control, the company that we have acquired, the company that we are now taking care of becomes our subsidiaries. So at the end of the year, what happens is that the parent company, so we're going to look at a financial statement, and then the parent company will prepare their financial statements. Okay? And then all the subsidiaries that we own will also prepare their financial statement. But at the end of the day, we want to find out what would happen if we put all of these together into a single account. So including or adding up the parent's financial statement and the subsidiary's financial statement is what results into the consolidated financial statement or the group accounts or consolidated accounts or preparation of group financial statements in relation to that. So when we are bringing these two sets of financial statements together, we are bringing the assets together, we are bringing the liabilities together, we are dealing with equity in a very special way. We'll look at that. Revenue will be dealt with together. Cost of sales will be dealt with together. All other expenses will also be handled together. So the idea of the preparation of the consolidated financial statement comes because now a company owns another company and then they want to now prepare a single financial statement. That is one financial statement that will represent the entire group of companies. So that shareholders at the end of the day will find out, okay, when we put all our company together, what's our total assets? What are our total liabilities? What's our total revenue? What's our total cost of sales? What's our total expenses in relation to that? So that is why the group financial statement comes to being in relation to that. But the question we ask ourselves is, why will a company be interested in the formation of group? Why? What do you think? Put some of the reasons in the chat box for me. Why do you think a company will be interested in forming a group of companies? Why won't you have just a single company and you will be okay? Why will you want to form 3, 4, 5 companies so that we'll have Nhyira groups of companies, Despite groups of companies, multimedia groups of companies, general media group of companies, like that kind of thing? Why? Why do we do that? Why are we interested in that? There are some reasons cited for the formation of group of companies. So let's look at a couple of reasons for the citation or citing of group of companies. The first one is to exploit tax advantages. Exploit tax advantages. So organizations or companies will want to benefit from tax. How do we benefit from tax? Let's establish another company. So one way of tax planning is having a group of companies, so that sometimes what happens is that one company can transfer a revenue to another company in the same group that is in a lower tax margin, so that the group as a whole will be paying less tax in relation to that. So to enhance the tax planning and tax avoidance technique of the company, they may want to establish a group of companies so that they can deal with those intra-group issues in relation to that, so they can pay a slower tax as possible. That is one of the reasons, to exploit tax advantages. The second one is goodwill associated with large companies. Goodwill associated with large companies. Because if you have a group of company, there is a goodwill, you have an opportunity, you have advantage. When you are going for funding and they look at the consolidated financial statement, we realize that you own 5 companies, your access to loan, your access to supply, your access to opportunities, your access to government contracts will be much higher than a single company coming in. So for goodwill that is associated, the opportunities associated with having a group of company, that could be also another reason why there will be formation of groups of companies. All right, I see you, Chachu, Secretoses, you are welcome. Then another reason is exploitation of intra-group or intra-company trade. Exploitation of intra-company trade. Now, if I produce goods and services, right? I produce goods and services, and I need raw materials, then I need to go and buy the raw materials from another company. Okay, isn't it possible for me to acquire that company so that that company becomes part of our group? That way, they are going to sell to me at a price lower than they should have sold to me on the original basis. So exploitation of intra-group trading or intra-company trade is also one of the reasons why you establish groups of companies, because you see, it's better to buy from your company that so the money will be circulating. So for instance, let's say we have a group of companies and we have a bank in there, we have an insurance company in there, we have an educational institute in there, we have a real estate in there, we have hotel and hospitality in there. Now, what do you think is going to happen? All our employees will have their accounts in our bank, isn't it? Then when we want to train our employees, they want to advance their education, they will go to our educational institute. At the end of the day, if we want to insure our vehicle, we want to insure our employees' houses, their vehicles as well, where do they go? They go to our insurance company. So you realize that at the end of the day, the money is just circulating in the group of the companies in relation to that. So exploitation of intra-company trade is also another reason why companies establish group of companies in relation to that. Then the last reason we can talk about is business integration. Business integration. Kamba, Kambai, I see you, you're welcome. Give us a thumbs up on the main video page so that we get more engagement on the video, and share it as well with your friends, colleagues, so we can get a lot of people coming on the stream. So the fourth reason is business integration. Like I cited earlier, once we have a group of company with subsidiaries doing various other things, what it means is that we don't have to go to outsiders, all right? So everything is within the group of company. We want insurance, one subsidiary does it. We want MBA students, one subsidiary does it. We want financial institution, or we want a bank loan, one subsidiary does it. So it enables the company to integrate its operations. We want tech. Okay, there is another subsidiary we have that deals with IT, technology, systems, softwares, app development, and everything that we need in relation to that. So to enhance business integration or business integration purposes, companies will cite group of companies in relation to that. So these are some of the 4 reasons we can mention for the citing of group of companies. Any questions so far? Kwame King, I see you. You are welcome to the stream. If you have any questions, please put it in the chat box for me, and then you give us a thumbs up on the video if you have not given us a thumbs up. And in case you've not subscribed, also make sure you subscribe to the channel and then stay connected with us. Right. So now that we have seen the reasons, or some of the reasons why we cite a group of companies, let's look at some key definitions when it comes to consolidated financial statements. So let's look at some key definitions, and these key definitions are in accordance with IFRS 10. Consolidated financial statements, IFRS 10. So according to IFRS 10, there are a couple of definitions that are critical, fundamental to the preparation of consolidated financial statements. So IFRS 10, consolidated financial statements. So what are these key definitions we need to look out for in relation to that? About 6 or 7 of them really quick, then we move on to the bigger issues in relation to that. Now, these things are very, very important so that we can set the tone for the foundation. Then we'll get into the bigger picture in a moment. So the first key definition we need to know about, according to IFRS 10, is consolidated financial statements. So when we say consolidated financial statements, I've already explained that to you, that the financial statements of a group in which the assets, liabilities, equity, income, expenses, and cash flows of the parent and its subsidiaries are presented as those of a single economic entity, right? So the consolidated financial statement is simply a financial statement of a group where the assets, liabilities, equities, income, expenses, cash flows of both the parent, right? The parent, and then the subsidiary or subsidiaries, okay, are presented as those of a single economic entity. So we prepare the financial statement as though it is just a single entity. That is what we mean by consolidated financial statement. Tofik Azuri, I see you. You are welcome. If you have any questions, put it in the chat box. The second key definition we need to have is the issue about control of an investee. Control of an investee. One of the things you're going to be coming across is the word control, and we will get into that in a moment. So when we say there is a control of an investee, so if I invest in your company, I'm the investor, you are the investee. So when we say control of an investee, what do we mean? Now, an investor controls an investee when the investor is exposed or has rights to variable returns from its involvement with the investee and has the ability to affect those returns through its power over the investee. Now, let me take that again. Ebenezer Arthur, I see you. You are welcome. So when we say control of an investee, we say an investor controls an investee when the investor is exposed to or has the right to variable returns from its involvement with the investee and has the ability to affect those returns through its power over the investee in relation to that. So that is what we mean by control of an investee. So it means that I control you because I have a right to receive returns from you. Not only do I have a right to receive returns from you, I have the power to influence how much returns I receive and even what you are going to be doing in relation to that. In that case, we say that I have control over you. So that is what we mean by control of an investee. Beneza said, oh, I'm late. You are not too late. You are not too late. All right. Any questions, put it in the chat box. The next one is investment entity. Investment entity. So what is an investment entity? What is an investment entity? An investment entity is an entity that A, obtains funds from one or more investors for the purpose of providing those investors with investment management services. So when we say an investment entity, it can be an entity that takes funds from one or more investors. And the reason why they take funds from those investors is to provide those investors with what? Investment management services. So you have your money, you cannot put your money into anything in relation to that. So you bring the money to me, and then I know how to invest your money. So I provide you with what? The investment management services. And because I'm using your, I'm like protecting your fund for you, you're going to be paying me a fee in relation to that. That is an investment entity. Another definition of an investment entity could be an entity that commits to its investors that its business purpose is to invest funds solely for returns from capital appreciation, investment income, or both. So I'm not going to be providing you with investment management services, but this time around, I'm going to be taking the funds, then I'm going to be promising you that, all right, we're not going to be providing with the returns really, but we are going to be looking at issues in relation to Priscilla Eduamwa Ado said, please, I am finding it difficult reading what's on the screen. Okay, what are you trying to read? The first one is CFS, that is Consolidated Financial Statement. The second one is Control of an Investee. And the third one is Investment Entity. Investment Entity. And we are explaining these terminologies in relation to that. So an investment entity can also be an entity that measures and evaluates the performance of substantially all of its investments on a fair value basis in relation to that. So consolidated financial statements, that is bringing the financial statements of a parent and a subsidiary as those of a single entity, economic entity, by bringing the assets, liabilities, equity, income, expenses, and cash flows together. The next terminology for us to define is a parent. A parent. So what is a parent? A parent is simply an entity that controls another entity. All right. So a parent is an entity that controls another entity. And you know that already, right? And a subsidiary is an entity that is being controlled. Now, when we say you control, it means we say you have power. Now, when we say power, what does it mean? IFRS 10 gives a definition of what that power means and what it actually represents. Power means that an existing right that gives the current ability to direct the relevant activities of an organization. So meaning that if I have the power, it means I have the ability to direct the relevant activities of the organization, both the issue in relation to your financial policies as well as operational policies. It means I have that power to directly affect that in relation to that. Emmanuel Addison said, please, is control the same as significant influence? No. Control is gained when you acquire a business, and we will come to control and significant influence in a moment. So Emmanuel Addison, stay with me. We will come to those in a moment. You gain control when you can influence the operational and financial decisions of the organization. But significant influence is where you buy like 25% shares of the organization. So you cannot really direct, but you can just participate and have a say in the making of the decision of the organization. But we'll get into these two things in a moment, okay? So Emmanuel Addison, stay with me. Kaya Olusan, I see you. Okay, you are welcome. Give us a thumbs up as well on the main video page, and then you share the video as well with your friends and colleagues. All right, so these are a couple of terminologies that we can talk about in relation to that. So in a simple language, we say that a parent is an entity that has one or more subsidiaries and controls those subsidiaries. And a subsidiary is an entity that is controlled by another entity known as the parent in relation to that. And we said that when we say control, control means that you have power to govern the financial and operational policies as an organization so as to obtain benefits from its activities. So control is simply the power to govern the financial and operational policies of an entity so as to obtain what? Benefits from its activities in relation to that. But when can you get control? When do we say, okay, this entity has control? When do we say this entity has significant influence. So in order for us to identify how control is obtained, we need to look at a couple of issues that IFRS 10 gives out. So there are a couple of guidelines that IFRS gives out as conditions which, when exist, will mean that an entity, being an investor, has control over the other entity, the investee, in relation to that. So let's look at the conditions that will be present to show that we have control. So control can be obtained in various ways. Number one, where the parent has power over more than 50% of the voting rights of the company. Okay, so more than 50% of the voting rights of the company, we say you have control. Now, more than 50% of the company you have control can come from two ways. Please stay with me carefully on that. So you have control if you have more than 50% of the voting rights of the company. This can be obtained in two ways. One, it can be direct acquisition. So this is where company A acquires 52% of company B. What does it mean? It means that we now have 50% of the voting rights, 50% or more of the voting rights of that company. And so now we control them. Are you getting it? But there are times when an investor can buy less than 50% in another company, but can negotiate with other investors or have an agreement with other investors so that the other investors will bring their voting rights or will transfer their voting rights to the investor. So in that case, the investor now obtains what? Control. So it can be through direct acquisition or through agreement with other investors. Okay, so two ways we can obtain controls: through obtaining 50% or more of the voting rights. Direct acquisition of the company. So company A acquires 51% of company B. Boom, they have control. The second scenario is that, for instance, company P acquires 40%. Now, acquiring 40% doesn't give you control. It gives you significant influence. But after we acquire 40%, let's say that the rest of the investors are Q. Q owns 20%. Z, let's say Z owns 35%, making how much? 95. And then let's say that B owns the 5%. So look at what is happening here. We are the main company and we have 40%, right? Then there are the other investors. So there are three more other investors, and these three investors, one has 20%, the other has 35%, and the final one has 5%. The question is, we can speak to this guy and say, hey, listen, why not you guys help and give us your voting rights? Because we have been in this business for a long time, we can make a better decision for you guys. Listen, P, you have only 20%. You can't really make much decisions. Listen, B, you don't have much voting rights. I mean, you are barely insignificant. So can you transfer your voting rights? Then with agreement with those shareholders or investors, let's say that the 20% and the 5% transfer their voting rights to us. So what is happening here? We have 40, we have obtained 20 from one investor and 5 from another investor, which means that now our voting rights become what? 65%. For that reason, we have 50% or more of the voting rights of the company, so we can say that control exists. We can say that they are our subsidiary. So that is the first condition that must be existed, that can exist for us to say that control has been obtained, where the investor or the parent company has 50% or more of the voting rights of the company. And this can be obtained in two ways: through direct acquisition or agreement with the other investors. Any questions, please put it in the chat box. And if you are watching, give us a thumbs up on the video, on the main video page. That way we get more engagement and YouTube will be able to push the video so we can reach as much people as possible. So that's the first way control is obtained. So let's move on to the second way we can obtain control. In addition, either having this 50% or more voting rights directly or through by agreement with the other investors. The second condition is this: let's wipe my screen up. So second condition, that the parent has the power to govern the financial and operating policies of the entity. Okay, so power to govern the financial and operational policies of the entity. This is the second way control can be obtained. The parent has the power to govern the financial and operational policies of the entity. Now, there are two ways this can also be obtained, either by statute or by law, or under an agreement. This one is an interesting one. I love this one. Now here, this is what is happening. We've acquired, let's say, 40% of the company. Acquisition of 40% of the company means we don't have 50% voting rights. But there are some times when there can be a government policy in some countries where if a listed company invests in a non-listed company, irrespective of how much share they acquire in them, automatically by law, by the legal regulatory requirements of the country and of the industry, that investee firm becomes a subsidiary. For that reason, the listed company will have more members on the board of the investee company, even though they have acquired less than 50% of the voting rights. Are you getting the concept here? So by law, for instance, a listed company investing in an unlisted company, when that happens by law, the regulatory requirement can say that the listed company should have 4 people on the board. So by law, it means that the investor company or the investor company, the listed company, now has what? The power to influence or govern the decision of the organization in terms of financial and operational policies. Then sometimes it is not by law, but by agreement. I love this one also. By agreement simply means that, for instance, a venture capitalist firm can, or a venture capital firm can say that, hey, we want to invest in your company, but we want to invest and we acquire only, let's say, 35% of you. But we want to have more people on the board, all right? We want to have more people on the board. In that case, It means by agreement, and the investee company say yes. That means that by agreement, we now have what? The power to govern the financial and operating policies of the entity. For that reason, we say that what? There is control. So this is the second way control can be obtained. That is, the parent has the power to govern the financial and operational policies of the entity. And like I said, this can be by law, that is according to statute, or under an agreement, that is between the investor and the investee. John Edu said, oh, I'm late. Yeah, John, you are late. Sumobi. We are looking at the consolidated financial statement and discussing a couple of issues in relation to that. Any questions, please put it in the chat box as we continue. So the first condition that must exist for us to say there is control is that the parent has the power over what, 50% or more of the voting right. And the second one is that the parent has power to govern the financial and operational policies of the entity. And like I have said, this can be through law, by law, according to statute, or under an agreement between the investor company and the investee company. There is a third condition that must exist for us to say there is control. So let's look at that. The third one is that the parent has the power to appoint. The parent has the power to appoint or remove majority of members of board of directors. This is the third way, or the third condition, or the third way that control can be obtained. So the parent has the power to appoint or remove majority of members of the board. This is more or less like simply having more people on the board. So now remember, the board members will have to always be an odd number, right? So let's say we have a 9 board member company. If the investor can appoint and remove, let's say 5 people, or maybe 6 people, okay, so that the investee company has only 3 people on the board, what does that mean? And what does that tell you? It tells you that we have control because we can appoint a lot of people on the board and we can remove a lot of people also on the board. So this is also the third condition that must exist for us to identify a subsidiary in relation to that. Then there is a fourth condition that must exist for us to identify this. And that's going to be the parent has power to cast a majority of votes at the meetings of the board. Okay, so power to cast majority of votes at BOD meeting. Now you could see that these conditions, some of them are like overlap, so they are similar to the other because that is how it is at the end of the day. So if the parent company has more voting rights on the board, come on, you are a subsidiary straight up. So even if we have acquired only 40%, it's supposed to be an investment in associate. We are supposed to have significant influence. But if we have 6 people on the board, meaning we have more voting rights, by virtue of having more voting rights and more people on the board, what does that mean? It means we got control in relation to that. So these are the conditions that must exist for us to identify or say that, yeah, there is a subsidiary in relation to that. Any questions, please, in the chat box so far? Any questions, any questions, any questions? Put it in the chat box. I'm going to be reading all of your comments and answer them all. Now, can every entity prepare consolidated financial statements? The answer is no. Not all entities can prepare financial statements. Okay? Not all entities can prepare financial statements. So let's look at some entities or some conditions which, when exist, prevent an entity from preparing consolidated accounts or consolidated financial company or financial statement, sorry. So one, where the parent itself is a wholly owned subsidiary. The parent itself is a wholly owned subsidiary. Now, let me explain this point to you. This point will be much clearer for you in relation to that when you are doing corporate reporting, complex group structure, but I'm going to explain it to you anyways here. So a parent owns a subsidiary, okay? And then that subsidiary also goes to invest in another company, all right? What we're saying here is that this P can prepare a consolidated financial statement. Are you getting it? Why? Because we own S and S owns the other company. However, S cannot prepare a consolidated financial statement because S, our subsidiary by itself, it's owned by us in relation to that. I hope you get a concept in relation to that. So that is the thing about consolidation. So that's the first thing. So once the subsidiary itself is a wholly owned subsidiary, you cannot prepare consolidated financial statements. Two is the parent securities are not publicly traded. Bernard Kwabena said, I'm late. Yeah, you are a bit late today. I guess you are quite late. Don't worry, you can watch the playback. We're looking at consolidation. If you have any questions, put in the chat box and give me a thumbs up on the video page. So two, the parent securities are not publicly traded, sorry. Securities are not publicly traded. So that's the second, that's the second thing. So the parent securities are not publicly traded. So why are you why would you want to prepare a group financial statement? So your security, now when we say securities here, we're talking about shares, we're talking about bonds, we're talking about loan notes, we're talking about debentures, all of those things should be publicly traded to some extent for us to find out the issue in relation to consolidation about that. Now, remember, everything I'm discussing with you here, it's in line with the issue in relation to IFRS 10, okay, IFRS 10. So the first thing, the parent itself is a wholly owned subsidiary. Second thing, the parent securities are not publicly traded. You cannot prepare consolidated financial statement if your shares, your bonds, your loan notes are not publicly traded. Number three, it is not in the process of issuing securities in public security markets. Okay, so right now, your shares may not be on the stock exchange or you will not be issuing any securities on the stock exchange, but you are in the process. If you are in the process of issuing securities in the public security market, on the Ghana Stock Exchange market, on the New York Stock Exchange market, or the London Stock Exchange market, then you can prepare a consolidated financial statement. So the third group of entities that cannot present their or prepare a consolidated financial statement is that it is not in the process, okay, of issuing securities. It is not in the process of issuing securities. Pawili, I see you. It is not in the process. So number one, the parent itself is a wholly owned subsidiary. Number two, the parent securities are not publicly traded. And then number three, the parent securities are not securities in the public. And then number four, is that the ultimate or any intermediate parent publishes consolidated financial statement that comply with IFRS in relation to that. So these are a couple of entities who are exempted from the preparation of financial statements in relation to that. Sylvia Ahino, I see you. Ahido, sorry. I see you in relation to that. Okay. So now that we've looked at the issue in relation to the consolidation, what do we do? How do we go about it in relation to that? According to IFRS 10, there are a couple of things that we need to note on the consolidated financial statements. So let's look at these couple of things that we need to note when preparing the consolidated financial statement. Number one, we combine like items of assets. Okay, Mustafa Iqbal, I see you as well. He said, I'm also late. Yeah, I guess you're late as well. We're looking at consolidation. Give us a thumbs up on the main video page. If you have any questions, you put it down in relation to that. So according to IFRS 10, there are a couple of procedures that we can follow when we're looking at consolidated financial statement. The first one is that we combine like items. Now, when we say combine like items, we're talking about assets, liabilities, equity, income, expenses, cash flows of the parent with those of its subsidiaries. So we combine like items. So assets of the parent, assets of the subsidiary, liabilities of the parent, liability of the subsidiary, revenue of the parent, revenue of the subsidiary, expenses of the parent, expenses of the subsidiary. That's how we get the consolidation or the consolidated results. Then the second one is that we offset or eliminate the carrying amount of the parent investment in each subsidiary with the parent's portion of equity of each subsidiary. And we'll look at this one later on in relation to goodwill. So we offset, or if you want, eliminate we offset or eliminate the carrying amount of the parent investment in the subsidiaries with goodwill. So you realize that when preparing the consolidated financial statement, How much the parents pay the subsidiary doesn't come on the face of the consolidated financial statement. Okay, it is on the parent's financial statement, but it won't come in the consolidated financial statement. Instead, what comes on the consolidated financial statement is that the carrying amount of that investment will be replaced by the goodwill in relation to that. So that is also the second principle that you have to understand in relation to that. And then the third key thing that we need to understand about consolidation, it's going to be the issue in relation to eliminate in full intra-group assets and liability income. So eliminate in full intra-group transactions. Intra-group transactions. Because you see, at the end of the day, remember we said the consolidated financial statement is where we are preparing the financial statement as though it's a single economic entity, isn't it? So if a parent owes the subsidiary or the subsidiary owes the parent, we must cancel the debt out. Because if we are now a single company, I can't say you owe me, you can't say you owe me, all right? So we're gonna be canceling the debt out, canceling all the transactions out in relation to that. So three key issues IFRS 10 recommends we look at. And the first thing is the issue in relation to eliminating or combining like items like assets, liability, income, expenses, cash flows. Number two, replacing or eliminating the carrying amount of the parent investment with the goodwill figure. And then number three, we eliminate in full intra-group transactions in relation to that. David Sam said, kindly address the clarity of your writing, said, but in summary, well done. Okay, thank you. So these are some of the things that we need to understand according to IFRS 10 on that. Emmanuel Addison said, with the investment, hope there can be other investment apart from the intergroup investment. Emmanuel, clarify your question for me. I don't understand your question, Emmanuel. With the investment, hope there can be other investments apart from the intergroup investment. I don't get that. Re-clarify that for me. Bernard said, so sir, does that mean that you can consolidate but will not be eligible for preparing consolidated financial statement with regards to the conditions given? Yep. Because once you are outside a bracket of you not, or you being a wholly owned subsidiary by another person, then you cannot prepare consolidated financial statement because someone else must prepare it. Or you are not listed, then definitely you are not supposed to prepare it in relation to that. So yes, what you are saying is true. Emmanuel Addison, can you clarify your comment or question for me so I can answer you better? I'm waiting for you. Okay, so Bernard said, thank you, sir. You are welcome. Any questions, please put them in the comment box for me, the chat box for me, so I can answer all of your questions. Okay. So let's look at the steps involved in the preparation of the consolidated financial statement. And this is where the journey really begins. All right. So we follow the following steps in the preparation of the consolidated financial statement. To be specific, we may even start with the consolidated statement of financial position. So steps. 1, we establish the group structure. So establish. So that's the first one. We establish the group structure. Bernard said, say, I believe he wanted to say that there can be other investments. Yeah, I think he's saying something like that, but he is saying that apart from the intergroup investment. So I don't know what he meant by intergroup investment. That's why I wanted him to clarify his question for me. So the first one is establish the group structure. Number 2, we determine the net asset of the subsidiary. Determine net asset of the subsidiary. Very, very important. Number 3, we calculate any goodwill. Okay, so Addison said, yeah, apart from investment between the group. Yeah, certainly there could be other investments. The parent company could have investments in other ways, okay, other investment income that they will get, or the other investments that they will make in relation to that. So not only what they have invested in another company, but maybe they have put some fixed deposit somewhere. It's a way of investment. So there could be other investments apart from what is between the group. So step 1, establish the group structure, determine the net assets of the subsidiary. Step 2. Step 3, you calculate any goodwill. And then step 4, you determine non-controlling interest, NCI. Okay. And then number 5, you calculate the group retained earnings. I'm going to put 5 above. Calculate the group retained earnings. Now, whilst you are doing all of these, there is a working 6 I like to bring up, and that is dealing with intra-group trading. Intra-group trading. So we're going to be following these steps in looking at the issue in relation to how we consolidate the steps. And this is where the principles begin. Listen to me carefully. This is where the principles begin. So in case you've missed everything so far, what I'm about to start is what is critical to the examination. How you determine the group structure, how you determine the net asset of the subsidiary, how you compute the goodwill, how you value the non-controlling interest, both at the date of acquisition and at the reporting date, how you calculate the consolidated retained earnings, how you deal with the issue about the intra-group trading. This is where the principles begin. So I wanted to make sure you stay very attentive with me here as we take them one after the other. Any questions, please put them in the chat box for me. And if you are watching and you've not given us a thumbs up on the video, come on now, give us a thumbs up on the video. That way we get more engagement and YouTube will be able to push the video so we can reach as many students as possible. And if you have not subscribed also, make sure you hit the subscribe button and join the family, become a VIP member. That way you'll be the first to be notified anytime I go live or I release new lecture videos. So let's get into the principles of consolidation. So for everything we've looked at is to just consider, yeah, who can consolidate? Why do we consolidate? Okay, how do we consolidate? So we want to now go and look at the basic principles of consolidation. If you are solving a consolidated financial statement question, the following steps are what you go into, and I'm going to tell you when to do what and where not to do what. It's very, very critical. It's very, very important. So the first one, you need to establish the group structure. Now, the group structure shows us the parent shareholding, as well as determination of the non-controlling interest if there is any. So that is the first aspect we start from. So we're going to have the parent company. Let me show this a little right. So we have the parent company investing in the subsidiary company. So I'm going to do simple group structure on the left and then complex group structure on the right for the corporate reporting students as well. So let's say that the parent owns 80%. That means that of the bets, we know that the non-controlling interest, that is the shareholders of the other 20% are called the non-controlling interest, okay? So if we don't own the entire company, the other people who own the other shares of the company are called non-controlling interest. Formerly, we used to call them minority interest, but now they are called non-controlling interest. So we have a parent company investing in a subsidiary company, meaning the NCI is 20. At the group structure date, we need to determine two things, very, very important. We need to look at the date of acquisition, very, very important. The date of acquisition, and then we need to know the reporting date. So at the group structure, two things are critical: the date of acquisition and then the reporting date. Now, why is this important? This is important so that we can allocate the post-acquisition profit well. Number two, so that in case we are preparing the consolidated statement of profit or loss and other comprehensive income, what it means is that we cannot take everything of the subsidiary. We will only take the share of the subsidiary for the period under consideration if it is not a full year acquisition. Kamba said, please, I want you to explain the NCI again. Now, so the NCI, like I mentioned, simply refers to the shareholders of the other portion of the company, which we don't own. So if we own 80% of the company, the other people, the other investors, the other shareholders who own the other 20% are called the non-controlling interest. We are the controlling interest because we control the business. They are non-controlling interest because they can't control the business, right? They cannot direct the financial and operational operations of the organization or operational policies of the organization. So these are what we call the non-controlling interest, the other investors who owns the other portion of the company, who own the other portion of the company. But if we own 100%, then there will be no NCI. Okay, if we own 100%, there will be no NCI. So when we own less than 100%, but more than 50% so that we get control, then the other investors are referred to as non-controlling interest. So when we design our group structure, remember there is a mark in the exam hall for this, okay? There is a mark in the exam hall for this. So it's something that you need to do in relation to that. So like I said, designing the acquisition, when do we acquire the business, and then the reporting date. Like I mentioned, so that we can know the period of acquisition. Now, where the acquisition is less than 1 year, that means everything is going to become X over 12. Very, very important. If the acquisition period is less than 1 year, then everything will be X over 12, which means that, for instance, if we are preparing the income statement, when we are taking the revenue of the subsidiary and the acquisition period, or the acquisition period is, let's say, 5 months, then we'll take 5 over 12 of the revenue of the subsidiary. That is what we will add to the revenue of the parent for us to get the consolidated revenue in relation to that. This same concept will apply when we are sharing the post-acquisition profit. So if we are looking at the post-acquisition profit, that means that we need to take into consideration what? The X over 12 in relation to that. Kamba said, thank you, you are welcome. Now, still on the group structure, sometimes in the question, the parent controls another entity and has an investment in another entity. So let's call that A, and we will refer to that as investment in associate. Now, with an associate, it means that we don't have control, but what we have is what? Significant influence, meaning that we don't have the power to govern the financial and operational policies of the organization. However, we have significant influence over the financial and operational policies of the organization. So if it is an associate, we don't own 80%, we don't own more than 50%. So somewhere less than maybe 35% of the company, or less than 50% usually, that means it is going to be treated as what? An associate. This is a simple group structure. This is what you would do usually in corporate, in financial reporting. But let's come to the right side, where there is a complex group structure. So when there is a complex group structure, the big question we ask ourselves is, how do we design the group structure? So look at it. You ready? So let's say we have a company that has an investment in another company, that has an investment in another company also. I want you to take care here. So let's say we own 70% here. That means NCI on this level is 30%. When we are doing consolidation, what we want to find out is what is the non-controlling interest in the subsidiary. So let's say that the subsidiary has an investment of, let's say, 80% in the subsidiary. So we control the company that controls the other company. We know the non-controlling interest in our subsidiary, but the question we need to ask ourselves is, what is the non-controlling interest in the subsidiary? What is the non-controlling interest in the subsidiary? How do we go about that? And this is where I told you the principle begins. And if you start messing up here, then you're going to mess up everywhere. So you make sure that you're not messing up here. Are you following me? So stay with me carefully. So how do we determine the NCI? To determine the NCI in the subsidiary, we need to determine the CI in the subsidiary. In other words, we need to determine the controlling interest in the subsidiary. But someone may ask, Nhyira, how do we determine the controlling interest in the subsidiary? Please note that whatever investment the subsidiary makes, the parent has its portion of ownership in that investment. Let me take that again. Whatever investment the subsidiary makes in the subsidiary, the parent company has its share of ownership in that particular investment. What does that mean in practice? It means if we want to find out the parent ownership in the subsidiary, we will take the ownership of the parent in the subsidiary and multiply it by the investment. So it becomes 70% by 80%. Are you following the picture? So 70% by 80%. That is what is going to give us the controlling interest, because whatever investment the subsidiary makes in the sub-subsidiary, the parent has its share of ownership in that investment. So if we want to look at the NCI in the sub-subsidiary, we must first look at the controlling interest in the sub-subsidiary. How many shares does the parent, or what is the parent ownership of the sub-subsidiary? So we multiply that up, 70% by 80%, that's going to give us 56%. So it means that the parent company owns 56% of the sub-subsidiary. All right, 56%. All right, so Covenant has that there, 56%. You need to multiply it by 100, 56%. Now, if this is how much the parent owns in the subsidiary, that means that we can now calculate the NCI. So the NCI in the sub-subsidiary will be 100% minus the CI 56%. And that's going to be what? 44%. It means the non-controlling interest in the sub-subsidiary is 44%. Does it make sense? So this is how we get the NCI value in the sub-subsidiary. And like I mentioned, this is corporate reporting level, okay? Okay, so I see a comment from David Sam. So David Sam said, can we have a group structure where no one owns up to 50%, plus investment in the other company, but yet enough was said to tell that one company has control over the other? Yes, that happens. You know, I mentioned that the parents can actually gain control when they own less than 50% of the voting rights of when they own less than 50% of the company. So for instance, if I should acquire 30% of a company, it means I've acquired 30% of the voting rights. Do I have control? No. But let's say that there are other investors, like I mentioned earlier. So let's say that Bernard has 20%. And then you, David, let's say you also have 40%. And then let's say that Kamba has the 10%. Okay, so I have 30%. Bernard has 20%. I have 30. Bernard has 20. Then David, you had 40, and then Kamba had 10%. I can come and negotiate with you guys, especially to Bernard and then Kamba, and tell them that, hey, Bernard, you have only 20%. You can't make a better decision. Why not transfer your voting rights to us so that we can make a better decision for you? So we manage your investment portfolio in relation to that. Then we speak to Kamba as well. Kamba also said, okay, he will give. So Kamba and Bernard transfer their voting rights to us. So realize that even though we directly own only 30% of the company, Bernard and Kamba has transferred or have transferred their voting rights to us. So now I'm going to be having what? 70%. So since I have 70% ownership, it means I have control in the company. So yes, we could acquire less than 50% of the company, but there could be a statement in the question that will indicate that yes, there is a control and we need to do a full consolidation on that. David Sam, are you okay? Let me know if you're okay. If you have any questions too, you know what to do. Please put it in the comment box. I'll be replying all of your questions for you. And give us a thumbs up on the video, all right? Give us a thumbs up. That way we get more engagement and YouTube will be able to push the video so we can reach as much people as possible. So give us a thumbs up on the video if you have not. So that's the group structure, step one. Remember, whether you are dealing with complex, now this is just one way of determining the complex group structure thing. Note that there are times when the examiner will tell you the percentage of ownership. That one, you don't have a problem. But there are other times the examiner will not tell you the percentage of ownership. The examiner will just say A acquires this shares of B. And so you will have to compute the control yourself, or the percentage of ownership yourself. Alhaji Jalo, I see you. Thank you for the thumbs up. Give us a thumbs up on the main video page as well. So let's look at where we would have to calculate our own ownership. So let's see this. Let's say that K Limited acquired I just want to do ACQN. So K Limited acquired 5,000 shares of the 8,000 shares of Y Limited. So K Limited acquires 5,000 shares of the 8,000 shares of Y Limited. So here we need to calculate the percentage of ownership ourselves, okay? And based on the calculation, it could be an investment in associate, or it could be a consolidation or a subsidiary subsidiary. So let's see how it goes. So to get a percentage of ownership, or the percentage of shareholding, that is going to be 5,000 over 8,000 times 100. And that is going to give us 62.5%. Okay, Bernard, that was quick. Thank you. So 62.5%. So it means that if we own 62.5%, so the group structure is going to be like this, K and then Y. So it's going to be 62.5, then NCI, 62.5 minus 100. That will give us 37.5. In relation to that. David Sam said, thanks. My concern above was well explained. Okay, David, you're welcome. So this is how we go about it in relation to that. So there are sometimes when the group or the ownership or the shareholding will not be given, but the examiner will tell you the number of shares that has been acquired. Yes, Bernard, 37.5, thank you. So if the examiner tells us the number of shares we have acquired, then we can calculate the percentage of ownership. Once it is more than 50%, it's a subsidiary, okay? But if it is less than 50%, then it's going to be an investment in associates. Are you getting the idea? Good. So where we have an investment in associates, how do we account for? So how do we account for that? Let's see how we account for investment in associate. Investment in associate is accounted for in accordance with IAS 28. So according to IAS 28, so investment in associate, remember here, what do we have? We're going to be having less than IAS 28. We're going to be having less than what? 50%, which means we don't have control, but rather we have what? Significant influence. So how do we account for that investment? Here we cannot calculate goodwill, so we account for it in accordance with IAS 28, yes, using the equity method like Bernard has mentioned. So we bring the cost of the investment. That is how much we paid. Then we bring share of profit or loss for the year. That's post-acquisition. Share of post-acquisition profit or loss. If it is a profit, we add. If it is a loss, we will be deducting. Then any impairment on investment in associate will be subtracted. Please note, the impairment we are bringing here is not impairment in goodwill. Impairment in goodwill will be dealt with later on. But the kind of impairment we are bringing here is the impairment in our investment in the associate company. So maybe we bought a company and during the year, they were involved in some dubious thing, and so their share price falls. And so our investment suffered an impairment. That investment that is suffering an impairment will be deducted when we are determining the carrying amount of our investment. Remember, the share of profit or loss will go to the group retained earnings. If it is a profit, we add it to the group retained earnings. If it's a loss, we will deduct it. When we get to the group retained earnings, we're going to be looking at this as well. Then the impairment of our investment in associate will be deducted from here and will also be deducted in the group retained earnings. Then whatever dividend we received will also be deducted in relation to that. Usually we receive the dividend out of the profit of the company. So share of profit is added. Whatever dividend we receive, maybe let me write it in full. Whatever dividend we receive will be deducted in relation to that. So we sum it up, and the figure we get is the carrying amount of the investment in associate, which will be taken to the consolidated statement of financial position under non-current assets in relation to that. So that is how we account for the investment in associate. The cost of the investment, we bring post-acquisition share of profit or loss. Impairment in goodwill will be deducted. Then the dividend that we receive during the year will also be deducted in relation to that. Any questions, please? Put it in the chat box for me if you have any questions. Any questions so far? All right. So that's our step one, the determination of the group structure. Remember, in the group structure, I have embedded the investment in associates. I usually do it like that, but the investment in associates, if it is in the question, could be workings too after we deal with the group structure, okay? Because it's not all questions that will have the investment in associate. If it has, that will be workings too immediately after the group structure in relation to that. But anytime I'm lecturing it, I actually just deal with it under the group structure, because if you remember the group structure, I brought the associate and I brought the parent as well in relation to that. So that's the step one. Now, after we prepare or find out about the group structure, we determine the group structure. If we are preparing the statement of financial position, now listen to this carefully. Listen to this carefully. If you are preparing the statement of financial position, remember, we will do this investment in associate workings, for instance, if we were preparing the statement of financial position. If we are preparing the statement of profit or loss and other comprehensive income, that is the consolidated statement of profit or loss and other comprehensive income, we wouldn't have gone through these workings for the investment in associate. All we would have been interested in will be the impairment as well as the share of profit in relation to that. Because these two items will go to the consolidated statement of profit or loss and other comprehensive income. But if we are preparing the consolidated statement of financial position, then we do these workings. Number two, if we are preparing the consolidated statement of financial position, then the next workings we do is to prepare or calculate the net asset of the subsidiary. So we determine the net asset of the subsidiary in relation to that. That will be two if we are preparing the statement of financial position. So if you are preparing the income statement, you don't do this workings. For some of you, before we know it, you are started to do a couple of things even before reading the requirements of the question. So let's look at net assets of the subsidiary. So I'm going to present this in a way. So we're looking at net assets. So I'm going to bring the at acquisition, then at the year ended, or at the reporting date. Now, let me say this even before I go into this. When you are preparing the consolidated financial statements, this is something the examiner has mentioned. You will see students jumping up. Yeah, they are preparing the consolidated statement of financial position. So they won't do any workings. All they will do is they will put the pro forma down. Then they bring assets. Then they bring the parent, the subsidiary on. They leave the bracket open. They will bring building. They will bring everything. They will bring inventory. They will bring trade receivable. They will bring payables. That's what they will do first, though. Please, the examiner has said this over and over again. Doing that doesn't give you any marks. Listen to this carefully. Listen to this carefully. Don't start your consolidation by jumping to put pro forma. I don't know who came up with that, but that doesn't earn you any marks. If you do your workings and you're not able to prepare the consolidated financial statement, the examiner said you stand a chance of getting more marks than not doing any workings and just putting the pro forma of the statement of financial position down or the income statement down. So this is something you must note, because one of the things that we have realized is that students do this a lot. And because I read the examiner's reports a lot, I get, that is why I'm able to know this. So please put this in your mind. Don't go to the exam hall and think you are smart. You won't get anything for that. Don't put your pro forma down. Spend time, read the footnotes one after the other. Any footnote you read, you do the workings. Any footnote you read the workings. Any footnote you read the workings. That is how you will be able to answer the question and get more marks. And like I said, if you do all your workings and time is not on your side, so you're not able to extract the financial statement, you will get a greater portion or percentage of the marks than someone who just put a pro forma down. You may get 0 for that, or maybe 1 or 2. So please take note of that. Take note of that. Okay, I see a comment from Joseph Adai. Let me answer that real quick. Please, does intertrade between associate and parent affect the investment in associates? Yes, it depends. It depends. It depends. It depends. It depends. So let me say this for you, Joseph Adai, sorry. So let's say that, for instance, there is an intragroup trading. That's an excellent question, though, Joseph Adai. I love that. It escaped me not to talk about it. Thank you very much. So the parent had a trade between, there's a trade between the parent and then the associate. So let's say that the associate sold to the parent, okay? And at the end of the year, the parent has some of the inventories in stock, right? So it means we need to calculate the provision for unrealized profit. And that provision for unrealized profit has to be deducted from the post-acquisition profit of the associate before we will now take a percentage of our ownership of that in the calculation of the associate figure. So Joseph Adai, that is how it happens, and yes, there will be an effect on that. So if the associate sells to the parent and he has not finished, or the parent hasn't sold all of the things, that means that the profit that the associate thinks that he has or they have earned is not actually earned, because partly the goods are outstanding from the parent in the parent's books. So what is going to be happening is that we'll calculate the provision for unrealized profit and deduct that from the post-acquisition profit of the associate. Then we will take a percentage. But where the parent is the one selling to the subsidiary, that one, it wouldn't be an issue in relation to that. So yes, the intra-group trading between them could have an effect in that case. Any other questions for me? Okay. So let's look at the net asset. So we bring, I think I was on that, at acquisition. Don't know why when I'm writing acquisition, the C doesn't want to come. So at acquisition, then at year end, or at the reporting date. So remember, like I said, Bernard Corbiner said, "You are good, sir." Thank you, Bernard. So if we are preparing the net asset of the subsidiary, remember I said we would do this. John Edu said, my question was not answered. John, what was your question? John, it's like when you ask questions these days, I'm not able to get your question. So sorry about that, okay? So Joseph Ade said, thank you, sir. John Edu, what was your question? John, can you re-ask your question, because I can't see your question in the chat box. So I see, oh, I'm late. From there, you didn't state anything again. John Edu, please retype your question, because I think there is no question from you apart from your comment earlier saying that, oh, I'm late when you joined earlier. So please, you've not put any comments down. Please, you can ask your question. Kamba said, I wish you were here in Sierra Leone. Oh, okay. Don't worry, because of technology, I'm still in Sierra Leone, right? So you are watching from Sierra Leone, so I'm still there indirectly. Now, so in case any of you guys would want to connect with us, you know how to connect with us, right? So Kamba, you can connect with us on WhatsApp, and then we can see what we can do to assist some of you guys there in Sierra Leone much more. So you can reach us on WhatsApp +233 54 sorry 501149296. So Kamba, you can reach us on WhatsApp on this line, plus 2335011499296. And we can see how we can assess that deeper level for you to prepare well for your exams. All right. Okay, so John said, please, in answering console question, do you have to finish with all the workings before consolidation starts, or which stage does consolidation actually start? Okay, John, this is the recommendation, generally accepted recommendation for you to get more marks, is to do all the workings before you go to the financial statement, period. John Edu, are you okay with that? So do all your workings before you start with the consolidation. Because like I mentioned, if you finish with all your workings and even you are not able to extract the financial statement, you are going to be getting somewhere like 12, 13 of the 20 marks without your workings alone before the financial statement. Okay, so you do all your workings before you extract the financial statement. Don't extract the financial statement and now go and be looking at things. No. You know the advice I give you guys all the time, that when you are dealing with consolidated, or when you're preparing financial statement in general, you don't read the whole question. We are going to be solving a consolidated financial statement question, possibly tomorrow or Friday, something like that. And you will see how I'm going to be solving the question with you. So you read note 1, you do the workings. Note 2, you do the workings. So you don't read all. By the time you finish reading all, like, you don't even know what to do. So John, do all your workings before you prepare the financial statement. And like I said, even if you're not able to prepare the financial statement because of time, you will be able to get a large portion of the marks by following the steps stated, right? Yeah, definitely by following the steps stated, because the step will go in that order to help you to get the figures in that orderly manner. You can't go and do group retained earnings when you have not done net assets, okay, of the subsidiary to get the post-acquisition profit, when you have not done associate to get the post-acquisition or post-acquisition share of profit or loss of the associate. Okay, you cannot, so it has to flow in that way. All right, John. Any other questions for me? Any other questions? Now, I understand this is a very technical area. So if you have any questions, please bring them up and let me address them real quick. Okay, so John Edu said, thanks a lot. You're welcome, John. Any other questions for me? Okay. So let's look at the net asset of the subsidiary. This is where you bring only issues about the subsidiary, okay? If it is a complex group structure, then you bring the subsidiary and then the sub-subsidiary. That's for corporate reporting students. You bring the subsidiary and you bring the sub-subsidiary. It means you are going to have two broad columns, and under each of the columns, there will be two columns for at acquisition and at year end. And sometimes people add a third column called movement. I don't bring that there. I like to bring my movement at the end of the day. So it's just an approach. So the first thing we bring all the time is the share capital. Okay, that will be found in the budget or in the statement of financial position given of the single entity. The same figure at acquisition may be the same figure at year end. If there is any share premium, we bring it up. mostly the same figure at year end will be the same figure. Sorry, the same figure at the date of acquisition will be the same figure at year end. Then we bring the retained earnings. Now, this is where you've got to be careful. I want you to be careful here. The retained earnings at the date of acquisition, we could bring that here, and that same will be at the end. And then the profit for the year will come to the year end. But be careful here, please. If it is not a full year acquisition, then the profit has to be splitted. Get this very well. If it is not a full year acquisition, meaning it's an 8-month acquisition, 9-month acquisition, a 6-month acquisition, that means the entire profit for the year cannot be taken to the reporting date. We need to split it and bring a pre-acquisition profit. So the pre-acquisition profit figure we will get will come to the date of acquisition. So please be careful about it. Be careful about this. If it is a full year acquisition, we don't have to think about anything. We just bring the profit and bring it there to the year end in relation to that. Now I see some comments. Let me reply to them real quick. Bernard said, sir, please, how is acquisition different from mergers? Okay, so mergers is where two companies come together to form a single company, whilst acquisition is when another company takes control of a different company. So they don't become, in acquisition, they don't necessarily become a single company, but in a merger, two different companies become a single company. Like Airtel Tigo did, it's a merger, okay? And then like Sahel, and then Omni Bank did, it's a merger. Like the way they merged all the financial institution, all those illiquid financial institution or financial institution in distress into what is called the Consolidated Bank of Ghana. That is a merger. I get it. So with acquisition, somebody goes to buy another person, finds a target company and say, we're going to be giving you this amount of money, and we acquire them in relation to that. So in merger, there will be nothing like consolidation. But where there is acquisition and the business continues to operate, then we will be having consolidation there. Nonetheless, you must note that there are times when a company may acquire another company, and the new company they've acquired, they won't allow it to operate on its own, but they will merge it into the company, their existing company. So that is also an exceptional case that is there. It is all based on the objective of the company that is doing the acquisition in relation to that. So they would decide what they would do. If they acquire and they allow them to operate as an individual on their own or as a separate legal entity, then it becomes their associate. Then consolidation may come in. But if they acquire them and they say, no, the way your operations are, we want to just integrate you or merge you into us, and you can't operate as your own, then it becomes a merger in relation to that. So Bernard, Kobena, are you okay with my explanation? Let me know in the chat box. Kambai said, in preparing the consolidated financial statement, what are the key things that requires workings? So I mentioned this earlier when we started. Let me list it down again. Number one, you need a group structure. Okay, you need to do workings for the group structure. Number two, if you are preparing the consolidated statement of financial position, you need the net assets of the subsidiary. Number three, if there is an associate, you need to do the workings for the investment in associate. Number 4, you need to calculate goodwill. This is a regular customer all the time. There is a 5 mark question, 5 mark reserved for the calculation of goodwill every time in the exam hall. So for those of you who don't like workings, you will always dodge this 5 marks. Sometimes it's 4, sometimes it's 5 for the goodwill. Then you need to value non-controlling interest. Non-controlling interest may be valued in 2 stages. We may have non-controlling interest at the date of acquisition and then non-controlling interest at the reporting date. And then the next one will be the consolidated retained earnings, or if you want, the group retained earnings. That is also a key thing we'll be doing workings for if we are preparing the statement of profit or loss. Sorry, if you're preparing the statement of financial position rather. If you're preparing the statement of financial position rather. Then as always, there will be intra-group trading. So we need to do the workings for any intra-group trading for provision for unrealized profits and how we can determine the total sales and cancel it out in the statement of profit or loss in relation to that. So CAMBA, these are the key things that will require your workings: the group structure, the net assets, investment in associates when available. Goodwill is a regular customer. You would always have to calculate that. And there is a 4-5 marks allocation for every consolidation question. And then non-controlling interest at the date of acquisition and at the reporting date, if you are preparing the statement of profit or loss, that is a consolidated statement of profit or loss. And then the consolidated group retained earnings, or no, the consolidated retained earnings, or what is called the group retained earnings, and then workings for the intra-group trading. So, Komba, I hope you are okay. Bernard said, okay, thank you, sir. You are welcome. Now, after we bring the profit for the year, remember the distinction I made for the profit for the year. I believe you understand, because I told you about the principles, yeah? If you don't get the principles, you're gonna be in trouble. So if you are watching, give us a thumbs up on the video if you have not given us a thumbs up. That way we get more engagement and the video will be pushed more to reach a lot of people. And if you have not subscribed to the channel also, make sure you hit the subscribe button and become a VIP member of the channel in that case. So we bring the share capital of the subsidiary, certainly, share premium if there is any of the subsidiary, retain earning at the date of acquisition, the same will be at acquisition, the same will be at year end. Then the profit for the year, I told you, if it is a full year acquisition, we bring it straight up to the end of the year. But if it is a mid-year acquisition or part-year acquisition, then we need to have a pre-acquisition profit, and then that pre-acquisition profit will become, or is what we brought at the date of acquisition. So Komba said, thanks a lot, sir. You're welcome. Then the next thing is my favorite area. It's called fair value adjustments. In every consolidated question, there is going to be fair value adjustments. Now, when it comes to the fair value adjustment, you have to listen to the question very well and know how the treatment is supposed to be done. So the examiner may say that at the date of acquisition, the net assets of the subsidiary are equal to the fair value, or are equal to the fair value, with the exception of land and building, which have a fair value above or in excess or below. Listen carefully. So when it comes to fair value adjustment, it could be above or in excess. If the examiner says above or in excess, what it means is that they have undervalued their assets. That is, the subsidiary firm had undervalued its asset, so we need to add it back. So anytime there is excess above, we're going to be adding it back. Okay, but if the examiner says below, that means they have overstated or overvalued their assets. So what do? We deduct it. Very, very important. So below is deducted. I believe you are following the principle very, very well. So fair value adjustment in excess or above, you add it. Below, you subtract. Now, anytime there is this fair value adjustment, apart from land, which is not depreciated, all the other assets may have to be depreciated. So when we bring the fair value adjustment like this, there is going to be excess depreciation in relation to that. Now, anytime there is above, that means there will be an additional depreciation that will be computed. Okay? Anytime there is above, that means there will be an additional depreciation. So that depreciation, post-acquisition period depreciation, will be brought to the end of the year and will be deducted. So let me present that this way. Unfortunately, my board is not too extended, so I'm going to rule a line here. Now, what I'm writing above should continue below. So you will continue below, okay? So the depreciation on the fair value adjustment, that's what I'm bringing here. And like I told you, if we were told about, it means the depreciation they calculated was low. So now the additional depreciation we are going to calculate in the post-acquisition period will be deducted. Does it make sense? However, where the fair value adjustment was below, meaning that they had overvalued their assets. And since they had overvalued their assets, it means they had charged. For that reason, when we calculate the depreciation for the post-acquisition period, what do? We add it back. Any question, please? Any questions, please? Now, fair value adjustment is one of the things students are not able to do. That's why I'm taking my time to explain that very carefully to you, so you get a principle and you get a concept there in relation to that. Any questions, please? So bring share capital, share premium, retain earnings, profit for the year, fair value adjustment above or in excess, you add. Below, you deduct it. You deduct. When it is above or excess, the depreciation in the post-acquisition period will be deducted. Why? Because it means that the entity had understated its assets, so it charged less depreciation than it was supposed to charge. So in the excess depreciation in the post-acquisition period will be deducted. But what that means the entity overstated its asset depreciation more than what it was supposed to charge. For that reason, the depreciation will be added back. So let's continue. I believe you put a pro forma down. I can continue because I'm going to clean some of them up to add a couple of things. Any questions, please? So let me now remove my line. So I'm just continuing, okay? So after dealing with the fair value adjustment like that, Kamba said, I need it to be repeated again, please. Kamba, what should I repeat for you? Kamba, let me know, what do you want me to repeat for you? Kamba, what do you want me to repeat for you? What exactly do you want me to repeat for you? Bernard said, I'm having some issues with my sound. I don't know whether it is from my side. What is the issue with your sound, Bernard? Enoch Tamaklo said, how do we treat the depreciation on fair value adjustment in pre-acquisition? No. Fair value adjustment, there is nothing about pre-acquisition. For the pre-acquisition, they have already done their workings already. What we are doing is what is happening after we acquire them post-acquisition. So fair value adjustment is always about post-acquisition and then not pre-acquisition. Then Emmanuel Addison said, please, you did not bring the post-acquisition difference column. Yeah, that was what I was saying, that I could have brought that third column, and I said I don't bring it up. I would, at the end of the day, I will look at the difference between the date of acquisition and then the year end, and I'll get a post-acquisition in relation to that. It's still the same effect, though. Still the same effect. Kamba said the explanation of the fair value. Okay. Then Enoch said, or depreciation on fair value only affects post-acquisition. Yes. So Kamba, let me take the fair value adjustment again. I said that with the fair value adjustment, the examiner can say all assets are equal to their fair value with the exception of building, which has a fair value above or in excess. So if they say above or in excess, what it means is that the entity had understated its asset, had undervalued its asset. So now that above or in excess will be added. The same figure will be brought at the date of acquisition and the same figure will be brought at the end of the year. Then I said, if they say all assets are equal to the fair value with the exception of plant, which has a fair value 2,000 below. Below means that the entity had overstated its asset. So it means we need to deduct it. So the below will be deducted. Then I'm saying that apart from land, all other assets are subject to depreciation. So there will going to be a depreciation on the fair value adjustment. So if it is above, it means that the entity undervalued its asset. So they had charged less amount of depreciation than they were supposed to charge. For that reason, the depreciation in the post-acquisition period will be deducted at the end of the year. Does it make sense? Will be deducted at the end of the year. So it will be deducted at the year-ended profit in relation to that. However, if it says below, meaning the entity had overstated its assets, so it had charged more depreciation than they were supposed to have charged for the year. So in the post-acquisition period, what is going to be happening is that the depreciation we will have will be added back to the profit for the year, to the year-end profit in relation to that. Kamba, are you okay with the fair value explanation now? In October said, great, it's clear now. All right. Richard Amegashi said, how do we treat pre-acquisition dividend? Pre-acquisition dividend, if the entity pays dividend and before we acquire them, that is our back case. We don't in consolidation, that is not our concern. The entity will deal with it in their financial statement, but we acquiring them, that is not our issue. It is when there is a post-acquisition dividend that we will be concerned about. But the dividend they have paid already before we came, that's not our concern. So Richard Amegashi, pre-acquisition dividend paid, that's not our concern and we don't have any control over that. And so that doesn't affect our financial statements. Kamba, are you okay? Are you good with the explanation? And then, okay, Kamba said thanks. Richard, you good with the explanation? Pre-acquisition dividend. So after we bring the depreciation, the next thing is my favorite area, and that is provision for realized profit. And you're going to be doing workings for this. Please note this. If the subsidiary was the one or is the one selling to the parent, and the parent had some of the inventories in stock at the reporting date, then you calculate the provision for realized profit. In that case, it means that the provision for realized profit will affect the subsidiary. So we will calculate the provision for realized profit and bring it to the year end and deduct it in the year end profit in relation to that. If the parent was the one selling to the subsidiary and the subsidiary had some of the inventory in stock, then the provision for realized profit will go into the group retained earnings. So please note, provision for realized profit will come to the net asset schedule if the subsidiary is selling to the parent. But if the parent is selling to the sub, provision for realized profit will go to the consolidated retained earnings or the group retained earnings. I hope you're okay with that. Emmanuel Addison said, please, it means pre-acquisition intangible like brand too can be revalued, but no depreciation will be calculated. Okay, yes, it can be revalued, but maybe amortization may come in. So Anderson, in that case, amortization may come in. So if the company had a brand, maybe they hadn't valued it. And these are other items that I would want to bring in my pro forma, or that I bring in my pro forma. So there could be other items that we could bring up here. So let me talk about some of the items. So let's say the company we acquire, they had a brand, they bought a brand, and we came to revalue it, and we place a value of $10 million. Okay, so that excess value must be added back to their assets. And if there is amortization, then we will calculate the amortization, and it will be treated the same way the depreciation will be treated. We'll deduct it from the end of the year. Okay. Or if they had capitalized a development cost, which they were not supposed to have capitalized, then when we acquire them, we now have to subtract that figure from the net asset at the date of acquisition. These are the other items that we have there. Okay, so they had capitalized an expenses they were supposed to have written off. So what is going to be happening is that we are going to be deducting that from the net asset at the date of acquisition. If they had also written off an expenses that they were supposed to have capitalized, then at the date of acquisition, we are going to be adding it back, like borrowing cost. Okay, like borrowing cost. So they were supposed to capitalize borrowing cost, but they were not capitalizing it. Okay, interest on acquisition or construction of qualifying assets. They were supposed to capitalize it, but they have not been capitalizing it, right? So now if we acquire them and they are supposed to capitalize it, what do? We add it up. Okay, we add it up in relation to that. Or there is provision on environmental cost. Okay, and they are supposed to calculate the present value and add it to the PPE and credit provisions. They have not done that. So when we acquire them, we must do it. You know, PPE will be debited and provision will be credited. So we will bring the PPE and add it, and then the provision will subtract it. These are all the other items that could be brought in the net assets. So Emmanuel Addison, these are the other issues that can come, and to everybody, these are the other issues. So yes, there could be a brand name that the company hadn't capitalized. Now, if we place a value on it and capitalize it, we add it to the date of acquisition. If there is any amortization, it will be subtracted in the post-acquisition profit or the year end. If there is a provision on environmental costs they were supposed to do and they have not done it, we will do it and debit the PPE credit provision and bring it up in relation to that. If there was a borrowing cost they were supposed to capitalize but they had written off, we are going to be adding it back to the date of acquisitions net assets in relation to that. If there was an expenses they were supposed to write off and they had capitalized, we are going to be deducting it in relation to that. So all of these are other items that could be in the question that we need to adjust in the financial statement in relation to that. So that is how we deal with that in that case. So Richard Amegashi said, thanks for the explanation. I'm okay. All right, that's awesome. So when we finish with everything, we get a net asset at acquisition, net asset at year end. Now, John Edu said, so in principle, if the subsidiary makes wrong entry in any form before acquisition, it must be corrected in the net asset at acquisition date. Yes. Yes. Then, if in the post-acquisition there will be any consequence of that thing we've corrected, it is accounted for. So, John, that is true in relation to that. Bernard Kobina said, thank you, sir. I have to go offline. We'll watch the playback. All right, Bernard, I'm almost ending lectures today as well. So now when we get the net asset at acquisition and then the net asset at year end, the net asset at acquisition will be used in the computation of goodwill. So when we are calculating our goodwill, this is the figure we bring. Then the difference between the net asset at acquisition and the net asset at year end will give us the post-acquisition profit or loss. And this post-acquisition profit or loss will be used when dealing with the group retained earnings or the consolidated retained earnings, as well as the year-end non-controlling interest. That is the figure that we are going to be sharing in relation to that. Okay, John said good. Emmanuel Addison said, thanks, sir. It's clear now. All right, Emmanuel. Okay, so that is the second thing we do in the preparation of the net asset of the subsidiary and the various adjustment that is done. So the net asset at acquisition will be used in the computation of our goodwill. Then the difference between the net asset at acquisition and the year end will be used as the post-acquisition profit or loss. And that will be used or shared between the consolidated retained earnings or group retained earnings, as well as the non-controlling interest at the reporting date. Remember, we do this workings if we are preparing the consolidated statement of financial position or the group statement of financial position. Please take note of that. We do this if we are preparing the consolidated statement of financial position or the group statement of financial position. If we are preparing the consolidated profit or loss and other comprehensive income, we don't need to go through all of these hassle. We just have to deal with the net asset acquisition if we are calculating goodwill in relation to that. But if we are dealing with a statement of profit or loss, that is the group statement of profit or loss, then we have to do at acquisition and at year end. So any questions for me? I'm going to be concluding today's lecture around this area today, or around this time today. I guess that it's been a great time for you guys to be able to understand this very critical topic in your CA, CIMA, CFA, and then ACCA examination, because it's fundamental and it's critical, and these principles are there for you to understand so that you can adequately prepare the financial statement. Let me say again, like John asked earlier, do all your workings before you go to the financial statement. Don't go and extract financial statement. You won't get anything for that. Don't go and put any pro forma down. No, go through the workings, do all your workings. After that, you go to the financial statement. Like I said, even if you're not able to go to the financial statement, the workings can get you between 12 or 13 marks if you did everything right, and that will get you to go through, rather than putting pro forma down and not doing any workings in relation to that. Then also, when you are solving consolidated financial statement questions, don't read the whole question. Chew the questions in bits. So I don't read all the questions. When I read the preamble, okay, I can get a group structure. I can start with the net assets. I can deal with various issues. Then when I read note one, what is in note one? I do the workings. Note two, I do the workings. Note three, I redo the workings. So before I know it, I read all of the questions in relation to that. If you say you read all the questions before you start workings, you cannot do it. You will be overwhelmed. You will be confused. So just ignore the other notes and chew the notes one after the other, one after the other. And that is how you can position yourself to excel in the consolidated financial statement examination in relation to that. So thank you very much, you guys, for joining the stream today. Very much excited for having you guys coming on every time to be with me on the stream. Don't take it lightly, because without you, I wouldn't be here to do this. So thank you very much for all of your questions. I appreciate the time that you take to be with me every time. Continue to stay connected. Tomorrow, we're going to be continuing with this as well. So we're going to be looking at part 2 of the consolidated financial statements tomorrow, where I'm going to go through calculation of goodwill, calculation of NCI, dealing with intra-group trading. These are also very critical principles that you must make sure you understand. So tomorrow, we're going to be going back into that. So make sure that you prepare yourself, and tomorrow, same time, 4:30 p.m., you join the stream. Subscribe to the channel, click on the notification bell icon, and select all notifications, so that when I go live, even if you forget and I go live, YouTube will send a notification to you, and you'll be able to get a notification, and then you can join the stream in relation to that. Then also do well to share the channel with your friends on WhatsApp, on your Facebook pages, on your Telegram platforms, and all other platforms, so that we can get as much people coming here to watch the videos and getting this content to help to prepare for the examination in relation to that. So thank you very much. Chachu, Ketosis, Kamba, Kwame King, Tofik Azuri, Ebenezer Atta, Priscilla, Edumwa, Tai, Eluzan, John Edu, Bernard, Pa, Willie, Sylvia, Ahido, Mustafa, David Sam, Alhaji Jalo, Emmanuel Addison, Enoch Tamaklo, Richard Amegashi, Charlie, and all of you guys, Thank you very much. Thank you very much for joining the stream. All right, Kamba, thank you. You are welcome. So thank you very much for joining the stream. So same time tomorrow, 16:30 GMT or 4:30 p.m. I'll be live on your way again as we look at the part 2 of the consolidated financial statement. And if tomorrow we are able to finish with the principles, then on Thursday and Friday, we're going to be solving practical questions on the consolidated financial statement, so I can assist you in order for you to understand how you actually go through these things in that case. So continue to follow us. The question will be solving on Thursday, Friday. The link will be shared on our Facebook page, as my Facebook page, as well as on the YouTube community channel or your community panel. You'll be able to get that as well in relation to that. So Basil Ekan said, thank you. You are welcome. David Sam said, thanks a million. Bless you too. Amen. Tomba and Brahma said, thank you very much for this lecture. You are welcome, Brahma. All right, so take care of yourself. Remember, coronavirus, as always say, is still with us here, right? Literally has come to stay with us. So make sure when you go out, you put on your face masks or your nose masks. You sanitize your hand regularly, wash your hand regularly, keep social distancing as well when you go out, and take care of yourself. Most importantly, continue to study. Don't give up on your dreams. Make sure you focus on your dream, irrespective of what is happening in the economy, what is happening in where you are located. Continue to have faith in God and continue to have faith in yourself. Add value to yourself. Keep studying, keep working hard, so that if all of these things end, and You are going to be writing the exams. You'll be in a better position to write the exams, and most importantly, pass the exams. You cannot spend all of this time in the house and go to write your exams and fail. It cannot happen. It is why we are doing some of this live stream. So make sure you spend some time, study, work hard, and I know that you can make it. So I'll see you same time tomorrow as we continue with our broadcast. Bye-bye.